Well, good morning, and thank you to the Eyecelerator Committee for having me here today. I'm Ryan Zimmerman, Medical Technology Analyst at BTIG. We're a private investment bank. Some of you may know me. You may have heard me on an earnings call, perhaps. Others may not. I'm one of the equity analysts, as Gil said, that follows the ophthalmic medical device space for Wall Street, or on Wall Street. Now, I've been coming to Eyecelerator for many years, and no offense to my banker colleagues, it's been all about bankers and not enough about equity analysts. And so I thought, and with Gil's permission, we would discuss a bit more on the investment process and the role that analysis in the decision to invest plays. And my agenda is just to provide a little context on equity research, and then we'll bring up, or we actually brought up a number of panelists, to discuss their investment process to help you better understand what drives value in ophthalmology. So I thought I'd start off with a little explanation about what it is that we do as equity analysts. And so our job as analysts is to predict where markets are going to go and advise clients, mutual funds, pension funds, hedge funds, where to allocate capital, which companies are best to own at any given time. And I'm picking on David here because everyone knows David and has seen him, but clients are choosing from thousands of stocks to own in their funds. And it's our job to be experts in the sectors that we cover. And so I cover medical technology. I cover 26 companies, everyone from Medtronic, Stryker, Intuitive Surgical, Alcon, down to some smaller emerging public companies. Now you may ask yourself, why does it matter what analysts think? Well, it's all about expectations. You often hear, on CNBC, analyst expectations were X, company reported Y. It's not about whether you're making progress. In the public markets, your value is determined relative to the expectations. So Alcon spun out, a few years ago out of Novartis, immediately went to a huge premium, about 29 times forward earnings. And that's about a 7-turn higher premium than other large cap MedTech peers because investors expected high performance out of Alcon when they came out. And so what's the value to the market? Well, the role of research is just to provide information to the market. A lack of information creates inefficiencies. That results in stocks being misrepresented, whether overvalued or undervalued. And then analyst coverage does actually help improve liquidity in shares and lowers the cost of capital for new equity issuance. And the value to BTIG as an investment bank is that we make markets, among other investment banking services, in the public companies that we research, and we help obviously raise money for companies. I think my bankers somewhere floating around here. And so, certainly that's part of the services that an investment bank would provide. Now, let's recap a little bit about the past few years in MedTech. So pandemic's in the rearview mirror now, not easy. There were reductions in mortality. There was strain on the healthcare system. We had field hospitals set up in certain geographies. And then you just have the general public, which still has, unfortunately, a pretty rudimentary understanding of public health. And that's prolonged the impact of the pandemic further than many of us would like. And so when you think about this, how does this translate into medical technology? Well, as we can now look back, we went through multiple waves of COVID, we went through multiple variants, and those admissions filled up hospital beds, and this had significant implications on the sector. Procedures that could be postponed were joint replacements, spine surgery, pain stimulators. A lot of elective surgery was put off. So how does this translate in the markets? Well, this is the chart of the IHI. It's the Medical Devices ETF. This has grown pretty steadily over the past 10 to 15 years. Except in early 2020 when we saw that gaping drop right here, and that was kind of when we all woke up to the realization that the pandemic wasn't going to just magically disappear, as our former president would so eloquently say. That's when the threat of real, significant economic shutdown became real in the markets. And the only people that knew to sell their stocks at the time were a handful of senators who thankfully were investigated. Now, even though procedures were held up for a period in second quarter 2020, MedTech bounced back pretty quickly. And the one constant in MedTech investing is that, and you guys know this, is that patients don't magically recover. They don't suddenly get better. Their procedures are put off, but their chronic conditions still persist. And so they still need a new hip. They need a new pacemaker. They need a new IOL. And so those things kind of came back pretty quickly. Now, this is a bit busy. This table's a little bit busy, but bear with me for the sake of argument. These are the annual returns of various healthcare subsectors and their relative performance to the S&P. And the key message here is that for most of MedTech's history, the subsector as an area of investment has outperformed the S&P. In the past 3 years, 21 through 2023, and I think Neha talked about this a little bit, the sector underperformed the S&P, making it harder to invest in, and I'll explain why that was in a minute. And when we look at 2023, when we look at 2023, MedTech significantly underperformed. You can blame interest rates, you can blame GLP-1s, you can blame supply chain dynamics, there's a number of things. Now, much of what our jobs as analysts has been in MedTech over the past few years is to not only navigate the impact and scale of COVID, but which areas would be hit the hardest and which areas of MedTech would see less impact. And so to do this, we're looking at, we run surveys, we're talking to physicians, we're doing other research to help clients understand what's going on the ground. And in a previous quantitative analysis, we compared how subsectors within MedTech are impacted differently. And if you look at, this is the 2008 financial crisis, you can see which areas took the hardest hits. Orthopedics, capital equipment, cardiac and diabetes did better. The reason is, it's generally harder to put some of those areas off than it is orthopedics and capital equipment. And so you see a dispersion in performance of the companies based on the subsectors within MedTech. And that generally carried through during COVID. Now, when we look at the IHI in the context of the IHI relative to the S&P, and I apologize for getting a little technical here, we see a decline in the premium investors are willing to pay in MedTech. And for a long time, MedTech was a safe haven sector versus biotech. And the risk of pharmaceutical pricing reform was not something we had to worry about. We didn't have to worry about a tweet from a president. And MedTech was kind of the safe haven sector versus pharma. But now that COVID has disrupted procedures and hospital staffing, MedTech really has faced some more existential issues in the markets as a sector. And that's why you're seeing that decline in the appreciation, and this is the appreciation by the market to incorporate the risk that procedure growth is likely to be limited either by a lack of staff, in ongoing supply chain issues, or other macro factors, inflation, oil prices, et cetera. Now, as we enter 2024, luckily we're starting to get back to a more normalized environment. And this is a survey, this is an example of a survey we run every year in March on a variety of topics in the ophthalmic sector, and it presents a very nice longitudinal picture of the market. And this question we asked about average wait times at practices of various ophthalmic practices to see where are wait times going. And they're actually moderating a little bit. And it's one data point that points to a more normalized environment that we're in as we go into 2024. And this is further supported by commentary and our own survey work from many of the larger companies that cataract volumes, as an example, are down slightly this year, or expected to be down slightly this year versus 2023, which has largely been driven by that backlog dynamic that we saw coming out of COVID. All right. Over time, the greatest factor in driving valuation and returns in MedTech stocks is revenue growth, and you can see a pretty direct correlation here. If you look at all the quantitative factors, revenue growth, operating margins, earnings per share, valuation metrics, et cetera, generally speaking, over the long run, we see revenue growth as the highest returns over time. Why is that? Most investors who participate in MedTech are growth-oriented investors. Those growth-oriented investors assume profitability will come. They don't reward profitability today. And to get there, companies really should try and participate in higher growth markets. What I show is this is the compound annual growth of all of the large caps in MedTech versus the valuation multiples those companies are afforded in the market. And companies that grow faster on a consistent multi-year basis are awarded kind of the highest valuation metrics. Generally, there's a pretty strong correlation, and those valuation multiples are really your ticket to generate real wealth for you and your companies if and when you make it to the public markets. And this is even more important for the SMID cap or small and mid cap companies. And these are the fast growth companies shown here. I've highlighted Glaukos, RxSight, and Star in red. Those are some of the smaller but high growth companies in the ophthalmic sector. And with that said, I know I moved through a lot. I want to leave time for our panel here. A lot more to be said on this topic, but let's move to the panel portion of the session to hear from investors who evaluate and participate in these markets every day. So with us, Gil's going to be moderating. We have Frank Coughlin from Columbia Threadneedle. We have Winston Chang from Polar Asset Management. We have Andy Corley, chairman of RxSight. We have Jeff Weinhuff, Visionary Ventures, and Neha Begwani from Morgan Stanley. So thank you guys all for joining us. Now, before we begin, I'm going to actually open up with a polling question to the audience to get some perspective from all you. I'm actually using this as an opportunity to get some market research, which I may choose to end up publishing later. We'll see. But what ophthalmic sector, if we could pull up the first polling question, what ophthalmic sector is most likely to generate the biggest investment returns in 2024? And feel free to answer here. Okay. Well, not a lot as a MedTech analyst can do for retina drugs, can they? That's good to see, though. All right. So let's move into some of the Q&A, and I'm going to open up this question to Frank and Winston as public investors, and maybe you can just help us talk through the process you use to analyze a company and how you value the company. Maybe, Frank, we'll start with you, and we'll go to Winston.
I would say, I think I would take the same process to any MedTech company. I think I have a respect for the somewhat of a logistical nightmare the operating room can be at times, and there are a lot of different stakeholders involved. It's not just the patient, but it's the surgeon, and it's the support staff, and there's a lot of different metrics to look at, and so I think I'm looking for technologies and for companies that have a respect for that, and kind of check as many of those boxes as possible. That would be kind of the general framework in which I go about looking at companies.
And Winston, for you, how do you evaluate companies? How do you value companies? What factors are you going into your analysis?
I think one of the big things that we're always trying to look at and to better understand when we're thinking about the revenue opportunity and the market size, the real addressable market size, is to be able to sort of understand, in my mind, sort of two questions. For the company and the product that they're looking to attack and go after is, one, what's the unmet need that the company and the product is trying to solve, right? To really understand what is it that is being done today that's failing and what the product can really address. And then the second aspect of it would be to try to understand how will the standard of care change to be able to adopt the new product that you're bringing to market. And so those are the two of the things that we really think are really important to understand clearly as you try to understand what the real revenue opportunity is. And of those two, I think the place that people struggle the most, I think it's easier to identify what's the unmet need because you talk to physicians and they talk to you about the limitations of practice today. But I think the harder thing to really understand is how the new product will or will not be adopted into standard of care. And so I think that's an important area.
Very nice. Neha, turning to you, as a banker, I'd love to get your perspective on kind of how you incorporate macroeconomic factors. You talked a little bit about this before, but kind of market sentiment into your analysis, especially as you think about new equity issuance, and how do you adjust for market volatility and even currency fluctuations?
Yeah, no, I think it's a good question because basically, when we're thinking about an IPO or even doing a follow-on offering for a large or an ophthalmic company, we try to make sure it's as de-risked as possible. So looking for multiple windows, making sure the company is ready ahead of time. I think what you want to make sure is you have a good sense of what investors are looking at. And to your point about growth being kind of the paramount thing, it's been interesting to see, I'd say over the last 18 months or so, there's been almost a bit of a bias too around this path to profitability and that becoming a bigger question. I don't think the days of saying, hey, we're going to be focused on growth and we'll be profitable way down the road, we can't give you a guidepost of when that's happening, works anymore for investors as an example. So I think for, IPO candidates today, they're going to have to say something like, we're focused on growth, but this IPO fundraise gets us to profitability, and you've basically funded the plan. So it's things like that. As I think about the macro environment, there's obviously choppiness that's out of our control, but it's making sure that you understand what the investor sentiment is and how you can make the company kind of as prepared as possible to go through the waves that inevitably will happen with market choppiness.
Fair. Jeff, I want to get your perspective as more of a private venture capital investor, and maybe just talk about kind of how you challenge your own assumptions and test your hypotheses, especially as you're kind of stepping into some maybe newer areas of the market that are unproven?
Thank you. You know, it's MedTech investing is challenging. Somebody made the point earlier about the haves and the have-nots, and if you look at year-to-date capital flows into ophthalmology and other life science investments, you know, the biopharma investments have garnered $18 billion of new capital in the first quarter, and MedTech is about $1 billion. And the biopharma side is up 4 times from the prior year, and the MedTech part is about flat. So when we think about challenging our assumptions, really all of the assumptions for MedTech investing, the bar is very high. So it takes a long time to get these things done. And in terms of being able to transact, you really need to be able to prove it to investors. So whether you choose to sell or choose to take public, you need to have the ability to show an established revenue trend in the $20 to $40 million range. So that's real. And we're fortunate to have 90 KOL doctors who are our partners to help us to test the assumptions for marketability and adoption. But I think Winston made a great point that theoretical adoption and real adoption are very different things. So it's challenging. We push pretty hard on making sure that we have not just a marginally better product, but something that's a meaningful improvement in the standard of care.
Very nice. Let me open it up for the second polling question now and see what you guys think. And you guys can play analyst for a little bit here. Which company is the most likely to exceed analyst revenue expectations in 2024? Very interesting. RxSight up there. Star put up a great quarter this morning. Patrick Williams is here. He let me know. Interesting. Very nice. Okay. Let's keep moving along here. So when you're talking to management teams, you're talking to the board, and I'd love to hear from Jeff and Frank and Winston on this. What are you asking management teams? Give us kind of your typical kind of Q&A and your thought process as you're kind of going through that activity. Maybe Frank, for you.
I would say it's sort of a mixture between short-term and long-term questions. I kind of like to see. I always get a little bit turned off when I meet with the CEO too much, because I always say to myself, well, then who's running the business? So I like to have a CEO or a management team that really kind of understands their business and their company and checks all of the boxes. I personally, and just if I reflect, and I think that you would agree with me, if I look at the really high quality operators who run these businesses, there's probably more micromanaging than there is sort of delegating. That's a success and something that I've seen over time. And so I'm kind of really focused on a lot of different parts of the business. I'm sort of equally focused on sort of the nitty gritty, but also the longer term vision, kind of where you see things playing out from a 1 to 2, 3 to 4, and then 5 to 6 year investment time horizon. So I think it's a mix of really in the weeds things, but also a longer term vision for the business.
Mm-hmm. Jeff, how about for you? Oh, sure.
So building off of a little bit of Frank was just saying, I think one of the important things that we try to understand is the alignment of what the management team is saying and how the company is structured. So in terms of if it's a very sales-driven organization, has the company actually structured in a way and is able to demonstrate how they're able to sell and succeed a lot more in that perspective, or if the message is innovation, to better understand what the innovation pipeline looks like and how the team is able to foster and to grow that. And so I think that's important to understand the alignment of what they're saying with the organization and also with what they're saying about the future as well. So that's one of the big things that we look at.
Thanks. I think earlier investors have different challenges. So public company investors are looking at a cake that's mostly baked. They're trying to figure out how to decorate it and how far it's going to grow, where we're actually trying to put the ingredients together to make sure they get there in the right space. So we're more interested in management's capabilities, but also how the plans work to address all the fundamental issues of building a company. And that means that you really need to know that your IP is solid. That's not as automatic as it seems. I think we need to know that the CMC will work and that we can manufacture a product the right way. And so when we're looking at earlier stage investments, we're always looking at the plan to do all those things and the progress against plan, not the actuality of it. And watching people who can grasp all the requisite elements, particularly the go-to-market part of it, where people are trying to figure out how to turn a market potential into a market reality, that's key. So it's a different perspective than a public investor.
I want to ask Andy here. We got Andy from RxSight here. Maybe Andy, how do you define a great company? You've had some successes through the years, and what is it that what metrics do you use to define a great company?
Well, thank you, Ryan. Good to see everybody. It looks like the storm has not prevented people from still showing great interest in the eye business, and I want to thank everybody for coming in out of this weather. Greatness is in the eye of the beholder, and it comes and goes on team effectiveness curves. But some general principles that I like to consider, first is people. I think that's a pretty generic statement, but people turn into great leaders. And so you have to have leadership to get the ball bouncing, and that's something that we see happen all the time. These normal people transform into leaders where they get people to buy into the vision, face the challenges that these companies face on an everyday basis, but they also have process. Have you ever wondered why a Burger King can go out of business, Chick-fil-A can take over the same building, and 2 months later they have to have someone in the parking lot directing traffic? Why is that? It's because great companies have great processes. But I think the thing that, in addition to obviously having great return on capital invested, which is a cornerstone of greatness, I think the great companies leave something behind for the market. They give something to the market that wasn't previously there. Is it a market expansion? Is it a new category? Is it a reimbursement code that previously had not been imagined? Lots of companies achieve financial success. A lot of companies achieve high levels of customer satisfaction, high levels of employee satisfaction. But the truly great companies leave something behind. They give something to the markets they participate in.
Very nice. Maybe Neha, for you, I'd love to get your perspective on the ophthalmic sector, really as an area of investment versus maybe other areas, and how you kind of evaluate that within pharma, within biotech, within devices, as you're going out and maybe pitching a transaction or thinking about equity issuance or M&A.
Yeah, no, I think, there's a lot of things that ophthalmology has that differentiates themselves from other, therapeutic areas. I think the large patient need, the global, especially on the emerging market size, that kind of opportunity set is something that's quite unique. I think it's some of the questions, though, that companies need to be more front-footed on. How reimbursement shakes out, how a product line fits within the workflow. Things of that nature are really where investors kind of question. And when we look at opportunity sets and where interest is kind of the highest, it's for companies and products where the need is high, the adoption seems as de-risked as possible, but also the commercialization strategy is one that is aligned with what the market is going to adopt. And I think you've seen some companies do better than others in kind of fitting that commercialization strategy with the products. And that, to me, is what, when we spend time with companies, that's what we look for is that alignment. Now, in terms of your question around MedTech versus, pharma and biotech, I'd say, if you looked at that data that I showed on my chart, it seems like biotech has kind of recovered faster on the ophthalmology side than on the MedTech side. I think this goes to the question around, reimbursement, around that commercialization strategy, and how de-risked it is. I think the more visibility MedTech stocks can give investors, the better off they are. And so I think that that is really reflected in when you unpack what has been the winners versus some of the ones that the stocks that have struggled in the sector.
Very nice. Is there something, and this is, I'm going to open this up to the whole group here, but is there something that one of your companies in their portfolio, which you'd call out that they do really well, that you think others should emulate? And conversely, if you can think of something that's been more challenging in your investments, that you'd call out that you know, you learned over the process as maybe a learning lesson for investing. Maybe Frank, I'll open up to you first.
Yeah, I mean, for the most part, this is a pretty Salesforce intensive industry. And there are a lot of companies, and I think you would agree, I mean, I think Stryker would be looked at as the sort of gold standard for how to measure a sales force. I understand it's quite a difficult place to work for, and I also understand they're quite nicely compensated, but I would look at that as a model and how they take extreme pride in their sales force, and it's actually incredible to look at where they've taken some businesses that you just wouldn't think they could, to areas that they couldn't take it to. And then on the negative side, I think where I've gotten it wrong is just kind of capital allocation is important, and it gets more important as you grow, and making decisions, at least from an M&A perspective, is important. And I tend to find that things go wrong when we kind of get outside of our swim lanes, when we kind of think that it's a good idea to get into a tangent that maybe is growing faster, but we're kind of getting too far out of our comfort zone here, and we don't fully understand the markets that we're getting into.
Yeah. Jeff, how about for you? Or Winston, either one.
I think we have an absolute minimum requirement of excellence in product design and efficacy and safety. That's super important. So we kind of set that as a given. The places that we've gone right are places where we've analyzed how to access the market the right way. So that means that, if you do a launch, and we've done a number of them, and we're still facing additional launches, you need to figure out how this fits into somebody's therapeutic regime, how they can really embrace it, and how you don't make one sale, but you make one presentation and someone actually embraces it and puts it in the daily routine. The most challenging thing for new products is, medical practices are busy and they don't have time to think about new things all the time. So if you can make something new, distinctive, better, and easily adopted, and something becomes part of the routine, that's critical. The place where we've missed is where we have thought that we had a market segment that didn't really exist.
Ryan, I've recently had a project where I got to speak to many of the sales managers in the eye world. And I was looking at your chart on the lasting effects of COVID, and one of the lasting effects is sales reps got used to doing Zoom and text and phone calls during COVID. And it's been a real challenge for the sales managers in our field to get their sales forces reactivated with face-to-face contact like we believe that it should be happening. And I think there's also been a decline in sales force competency. And when I'm talking about competency, I'm talking about the ability to answer all the technical questions that come the surgeon or come the practitioner's way. So I think that if you look at any P&L on any public company, the largest investment is in the sales and marketing line. And to have that asset not be at full capacity is a real challenge for a lot of our leadership in our company. And that's a problem that we're facing, and it's also an opportunity to reactivate those assets and maybe get better performance. On the positive side, I've seen more and more companies adopt really meaningful operational processes that will allow them to answer and resort to problem solving in a unified way across the organization that'll create better efficiencies.
How about for you, Winston?
Just real quickly, in terms of what I feel like real successful companies are able to drive towards is the idea of what a lot of this conference is about, is driving innovation, right? I feel like companies that are able to really drive innovation are ones that are able to really differentiate on a near term, but definitely a longer term. And one of the things that Andy mentioned that I really liked is how these companies can sometimes give something new to the market, right? It's a new product, or it's a new way of doing business, a new way of doing reimbursement. And I think that's so critical. And sometimes I see, especially with a lot of these larger companies, is they might not necessarily have or driving as much innovation, but for them to consider, acquiring or going after the innovation, I feel like that's a very critical part of driving a lot of the industry forward. And we talk a lot about why does biotech have such different valuations than medical devices? And it's largely because of innovation. Biotech innovates through science at a much more rapid pace than medical devices, which typically is innovating more with technology or engineering. Right. And I think that's a primary difference there. And I think that's an important thing for people to consider.
Yeah.
We have a lot of debates about why there's so many one-product companies in ophthalmology. And we obviously would like for there to be less one-product companies, but I think the reason there's so many one-product companies is because there has to be. It's the only way they can break through. You have to have that sales organization that is driving to work every morning thinking about survival, not how they're going to do on their next work performance review. And so when you have a team that's focused on survival, you start to get change in the marketplace as opposed to maybe a service organization that's larger and not as quite as passionate about breaking through.
Yeah, I would agree with that. I mean, I think it's easier for investors, at least on the public side, to evaluate one-product companies, and typically you do see a valuation premium if the company is successful of a company that does have one product. And just to follow up on Frank's point on Stryker, as an aside, since I cover Stryker, it has doubled the S&P over the last 20 to 30 years. I mean, you talk about durability of performance. It's been phenomenal as a medical technology company for investors and for the company. Next question for all of you is, do you feel like the ophthalmic sector as investors is easy for investors to understand? That, or do you find it intimidating? Sometimes I spend a lot of time educating generalist investors who are non-healthcare specific about the nuances in ophthalmology. So I don't know if you guys have any thoughts on this, maybe Frank for you, and Neha, be curious to get your perspective on the banking side.
Yeah, I don't find it too challenging relative to other. I think it should be more widely accessible to the sort of more generalist view. I've oftentimes thought about exactly why I feel like there's hesitancy in the ophthalmic surgery space. Maybe the one thing that comes to mind is reimbursement, and that could be a challenge. I think trying to figure out some reimbursement and how things are going to change, it can be like the bane of my existence at times. And sometimes it's you have a false sense of precision if you say, oh, I've got a handle on what CMS is going to do, because sometimes you just don't. And I think maybe that's it. But it should be something, and maybe myself and maybe other people need to be better about getting this space into the more generalist view, because it's quite accessible relative to some other areas.
Yeah, it's accessible, but I'd say that people generally think about it on a more global scale than maybe they would some other therapeutic areas. And so when you talk about reimbursement, it's also important for investors to understand what's the opportunity set in China, what is it in India, what is it in Europe, how did those countries kind of operate? And so I think for investors, they have to not only do work around what the technology is, but they have to understand what the market size and opportunity and how you penetrate that across many different regions, and that creates a bit more complexity around the work that they need to do.
Okay.
Ryan, if I can interrupt, we've got a question
go.
from the audience that I think maybe sort of feathers in with this, is that ophthalmology is unusual. It has both cash pay and reimbursement, and the reimbursement sometimes doesn't exist when you start out. So the question is, do you guys see a difference between cash pay and reimbursement, and complex? You just hit on the complexity. Glaukos just got a permanent J code yesterday. Maybe an upside surprise. People weren't necessarily expecting that. So how do you guys, that's really the question, cash pay versus reimbursement, and what risks will you take? Do you need to see reimbursement in place if you're going to make an investment?
If you look at the market and within large cap medical devices and even go broadly into healthcare, I tend to find there's a premium for cash pay. I think that investors will look at something where and I don't know if they look at it and say it's necessarily better. I think what they would saying is, I don't have to worry about stroke of the pen risk. I don't have to worry about thinking about what the MCOs are going to do. So I would say that's generally, I kind of look at it in everything in isolation, but I think in general, public market participants would say cash pay is better. But now when you do that, when you introduce more cash pay, you have to sort of put your consumer hat on, because there's out-of-pocket costs that need to be understood, and that in itself can be difficult for a healthcare investor at times, because it's typically not something we think about every day.
Yeah, I think the reimbursement mechanism is more fit for purpose. So, we're seeing the biggest category of cash pay right now that we have is in premium lenses for cataract surgery, and that's been successful. You look at what RxSight's done in the last couple of years, and that's been hugely successful. So, if there's a new product that really innovates and gives something different and virtuous that they can't otherwise get, people will pay for it. Not everybody, so that's 10 or 15% of the market. It's been, everybody's always thought it was going to be much greater, and it's taken a while to get there. But I think what we're seeing with products like RxSight that breaks out are important. I think the presbyopia drops are going to be an important cash pay product that is there. But for therapeutic stuff, there's no substitute for having payers, kind of lean into that and be willing to
Well,
pay
this
for it.
opportunity is too good to pass up. Let me tell you how I want you to think about it, okay? When you think about ophthalmology, think of the target audience we have for cash pay, 65 and older. Why do they rob banks? Because that's where the money is, right? So that's, if you noticed earlier on the data slides, we have a downturn tied to economics in refractive surgery into the macroeconomic situation. The premium channel isn't recession proof, but it is highly recession resistant due to the target audience that we go after with that channel.
I'm going to open up for one last polling question before we wrap up, and if we could pull up the third question now. Which company is most likely to make a large MedTech acquisition in ophthalmology in 2024? Where's J&J Vision? There we go. All right. Looks like David's going to be getting his checkbook out today. We got Alcon in the lead. Very nice. Well, I'm going to wrap up with one last question for the group here, which is, just in your view, how can companies increase their value? Anyone want to take a stab at that?
I would say innovation is clearly important, but also kind of meeting the goalposts that it takes to bring new innovation to market. I mean, it's hard. It takes years. I mean, we've seen products where it can take sort of 10 years, and I think investors get that. But just sort of meeting the goalposts to get there, you will get theoretically paid for that if you're checking the boxes to bring meaningful innovation to market and you understand what it takes to do that. And then I think as you sort of graduate into sort of bigger stage companies, the reality is that there will be a higher multiple of earnings or a higher valuation placed on your business if you consistently deliver what you say you're going to deliver. Now, there's always times when things don't go your way, but getting to the point where you have a handle on your business where you can say, this is what the outlook is, and we are going to deliver that. And I think we could show a lot of charts that will show how valuation sort of tracks that.
Yeah, I think it's about getting that commercialization strategy right. I think being cost efficient around it is something that public market investors are much more focused on. And so to say, this is what the opportunity set is, this is the technology, this is what I know will work with physicians, but I have a plan of how I'm going to attack it, and I know exactly what the Salesforce construct, their mode of operation, et cetera, needs to be, and having that alignment, I think, is super important, and what investors will want to understand that you as management teams know and can kind of attack.
We're always looking at younger companies, so proving the concept is fundamental. If you can show that you get traction against your market opportunity for real, and show strong metrics, show growth and margin, then that's how you expand your valuation, period.
Yeah, I would echo what Frank was saying. I think innovation is just so important for small companies, medium companies, and large companies, right? I mean, you could have a successful one-product company now that's doing well, generating cash flow, and creating value, but for investors that are really looking for something that has a true 3 to 5 to 10-year life, you really need to be able to demonstrate a pipeline and the ability to innovate and to create new products and bring them to market. So I think that's important.
High growth, high margin.
Very nice. With that, I want to thank our panelists and appreciate this session. Gil, I'll hand it
Great.
to you.
No, thank you very much, Ryan. This was a great panel.